And silver was still still suppressed under $50, but the miners, GDX had broken out to new highs, and I haven't actually checked what the price of GDX was, but considerably above the old 2011 highs or 2010 highs. I don't remember when it was. So in my view, the miners, well, we're in a correction. It still remains to be seen whether this is a minor daily cycle correction that may already be over. We may have printed the bottom a couple days ago, or if it continues and we got to go down and make a lower low, like an ABC correction, then this might turn out to be something that lasts a little longer, an intermediate degree correction. If that's the case, then it'll be maybe third or fourth week, and we would have at least 2, maybe 3 more weeks to go before the final bottom. But markets don't go straight down, so we'll have bounces, and so I tend to think most of the damage is already done. If we do have to make a lower low, I don't know that it's going to be a huge lower low. And then once it's over, it's just like every other correction that we've had for 6 years. Once they run their course, then the next leg up begins, and you get higher highs. That's the definition of a bull market. So bull market's not done. We still got, and I think we got big new highs coming once this correction's over, and once we clear the sentiment got pretty bullish. People were starting to make plans to buy their island, and that's usually about the time that you got to have some kind of a correction. So that's what's happening. Nothing out of the ordinary.
Maybe we could talk a little bit more about what did cause that correction in the gold price, because like you said, there was a lot of exuberance. And then when it was happening, people were feeling pretty nervous. So what was the reason that happened, do you think?
Well, I think there's two reasons. One is just sentiment. And you see this you see it at both bottoms and tops. People, there's a narrative. There's a reason for why price can't go down. When you're high and you're going up towards the top, Asians are buying, and that's the reason that there's shortages, and that's why price can't go down. Or if you're in a correction, there's the bull market's over and it's never going to go back up. There's always a narrative, and so at some point, sentiment, when you're getting close to a top, sentiment gets so bullish, there's just nobody left to buy. Everybody that's going to buy has bought. And so at that point, it doesn't really matter what the fundamentals are. The sentiment will overpower the fundamentals, even though the fundamentals haven't changed. We still got shortages with silver. It's just there's nobody left to buy right now. And so then price has to correct. And then what happens is smart money starts to sell. They take profits. You start to get a little correction. At some point, people start to get a little panicky, and they want to sell. Their stops get hit. They want to sell before they've lost all of their gains. That kind of exacerbates the selling, and I'm talking about an intermediate degree correction here. And that continues until the exact opposite happens. There's nobody left to sell. And then when that happens, the fundamentals resume. You still got shortages. And so the buyers come in, the smart money that took profits at the top, they start buying at the bottom. And the market goes back up and it makes higher highs. I tend to think we're probably in the parabolic phase of this bull market. I know I'm a little different than a lot of other analysts. A lot of people want to say this bull market's just getting started. No, this bull market's been going on since 2001. It's a very mature bull market, and we've started to go parabolic. There's usually a correction in the middle of that parabolic phase, especially for silver. There's a decent chance that this is that correction. It's volatile, it's scary. People become convinced that the bull market's over, and it ends up being a huge bear trap. And then you get a bottom, and then the next leg up ends up being as good, or in this case, I think multiples better than the first leg of the parabolic move. So the last 2 months have been amazing for, especially if you were leveraged. You made life-changing gains during this last 2 months. Your complacency is going to get washed out here, and a lot of people are going to, assume that the bull market is over, and then they're going to get stuck on the sidelines when the second phase of the parabolic move starts. And the second phase, I think, will be several times bigger than what we just went through over the last 2 months. So we went from 50 to 120. I think the next leg, when we're ready to break out above that 120, could take us to, it's easily going to take us to 250. I mean, that's only 100%. That's easy during a parabolic move. That's almost standard during a parabolic move. But for metals that are much more volatile, I think there's a very, very good chance at this point that we could go from 120 to 500. So I think the next leg is going to be a lot bigger than this first leg. And you think you made a lot of money during the first leg? You haven't seen anything yet.
Corrections often begin when optimism reaches an extreme. At market highs, narratives multiply, explaining why prices can only go higher. Eventually, buyers are exhausted. Even strong fundamentals can't prevent a pullback when sentiment becomes one-sided. Smart money takes profits, momentum stalls, and selling accelerates as stop losses trigger. Panic replaces confidence, even though supply shortages and macro drivers remain intact. These emotional reversals are mechanical, not mysterious. Markets fall until sellers are exhausted. Then the same fundamentals that were ignored during the decline quietly reassert themselves.
Generally, these commodity bull markets, they unfold in two phases. So the first phase of the bull market was from 2001, well, it double bottomed. So you could say either 99 or 2001, double bottomed, gold did at 255. So let's say you pick 2001, that's where the bull market started. The first phase ended at that top in 2011, but that wasn't the end of the secular long-term bull market. That was the end of the first phase of the bull market. And then we had a cyclical bear market, fairly short. What was it, about 4 years? It ended in the fall of 2015. And at that point, we started the second phase of the long-term secular bull market. So this phase, the second phase, is getting pretty mature. Started in 2015. We're in 2026, so we're getting close to 11 years at this point. And we've started to go parabolic. Gold, when they failed to keep the suppression at 2000, you can see what happened if you pull up a long-term chart. The character of the market changed. That was because the banks were caught in a short squeeze in the gold market. Eventually that kind of bled over into the mining stocks. They had big moves. Silver was the last to break the suppression. I thought it was completely broken, but I guess they still got a little bit of firepower here, because that was the second part of why this correction is happening. Some of it is we just got, way too bullish, ran out of buyers. We were due for some kind of correction anyway. And I think the banks took advantage of that and coordinated a huge overnight attack that dropped silver, whatever it was. I think it was almost 30%, or maybe it was 30% almost overnight. That allowed them to get out of their shorts, because a lot of those contracts were going to stand for delivery, and they were going to have to buy physical silver at $120 an ounce to deliver. So I think some of it was just sentiment got too bullish, and some of it was the banks needed to bail out, get out of those short positions. So I think that's probably what's happening, but it's not going to hold any more than any of the other corrections held. It's just going to make the shortages even more extreme, which just means that price is going to go even higher during this final phase. So, if our final target naturally would have been $250 silver, this probably guarantees the shortages are going to be worse, and that the odds are more likely now that it's going to get to $500. I think gold probably has a double from here once we break out. So I think our top was close to 5,600. I think maybe it even tagged 5,600. I think we're probably going to double during the last final parabolic bubble phase of this bull market. So once this is over with, the correction, we start the next leg up and we break out above 5,600. I I think we're probably going to at least double from there. So I think 10,000 is almost, I'm going to say it's a piece of cake. Doesn't mean it's going to be an easy ride to get there, but I think it's going to be a piece of cake. And we might even get to 11 or 1200. And now the other part of your question, I almost forgot. The other part of your question is this over when this parabolic move tops? Generally, I would say yes, although it might be that we just have a cyclical bear market. So let's say we get a parabolic top later this year or maybe early next year, and then we get a cyclical bear market, the same thing that happened from the 2011 top to that 2015 bottom. That was not a secular long-term bear market that lasted 15 or 20 years like the one from 1980 to 2000. It was just a cyclical bear market. It is very possible that might be what we would have this time, is just a cyclical bear market that lasts, the next 8-year cycle low is going to be due in 2030. So maybe it's only a 3-year cyclical bear market, and then we end up having a third phase to this long-term bull market. I am open to the possibility of that. But keep in mind, these parabolic moves, they tend to crash. So we could go to $500 silver. We could crash all the way back down to $100 or even $50 silver. And then potentially we could start a third phase of the bull market that could take gold to 30, 40, 50,000 during that third phase. So it's possible. I'm open to the possibility.
This precious metals bull market didn't start recently. It began over 2 decades ago. What we're seeing now is the late parabolic phase that typically defines the final act. These phases are volatile by nature and often include violent mid-cycle corrections, especially in silver. Such moves convince many participants that the trend is over, creating classic bear traps. Historically, the second leg of a parabolic move is often far larger than the first. Those shaken out early rarely re-enter in time, missing the most powerful gains of the entire cycle.
You have to be willing to change directions, and you can have your expectation, but if the market tells you that your expectation is not going to play out, well, then you have to adapt. Longer term, I don't see any need to adapt. I think we're still in a bull market. The gold silver ratio has not gone below 30-1 yet, and I expect that this attack by the cartel probably means it's going to go to 20 or even 15-1 before we get our final bull market top. So there's no need to adapt any of your long-term expectations at this point. Short term, maybe. This may turn out to be an intermediate degree correction rather than just a minor daily cycle correction. Again, it's not going to change the long-term outcome. It just means that the correction may last a little longer than first anticipated. My anticipation was that this was going to be a daily cycle correction and would be over, 8 to 10, 12 days, and then we'd start the next leg up. And that may still be possible. We just have to see what happens to gold here tomorrow and next week. If gold breaks back above that 10-day moving average, then we probably got our bottom here a couple days ago. And this is just a minor daily cycle correction. We'll go up, maybe hit 6,000. Then we'll get that longer term intermediate degree correction, something that lasts 4 to 6 weeks maybe. Otherwise, if this continues a little longer, then this turns into that intermediate correction. And so, just arrived a little sooner than I was anticipating, but it was going to happen anyway. And it's not going to change the long-term view. So it's nothing to panic about. I tend to think this will probably be the last one. Now, they've tried multiple times during this last 2 months to stop this rally. And every time they did, the buyers would come in and just kick them in the teeth, and they'd lose more millions of dollars. But we've reached a point where sentiment was extreme enough that we were going to run out of buyers. And I think they just jumped on the opportunity and slammed it in the middle of the night and slammed it hard enough to where it went down to where people really started to panic and sell. And they were going to be profit taking anyway. But I think people have a tendency towards recency bias, and they're going to assume that since this suppression worked, that the next one's going to work, and they're going to be gun shy. And that's going to mean that people are going to sell way too early during that final parabolic move. That they'll they'll want to sell at $150 silver, $175 silver, and they'll miss the move to 500. So don't let this, get lodged in the back of your brain that you've got to, that the cartel is going to attack again and that you got to get out early, because I think you're going to miss those once in a lifetime opportunity. That's the next phase. I think is going to go much further than most people expect. Really, I think you don't really want to sell until that gold silver ratio gets down to at least 25 to 1, and we may go as low as 15 to 1.
Two forces likely converged to create the recent plunge. First, sentiment had become overheated, leaving the market vulnerable. Second, heavily short positions needed relief. A sharp overnight decline allowed leveraged players to exit positions without facing physical delivery. These episodes don't eliminate shortages, they intensify them. Each forced liquidation tightens future supply and raises the stakes for the next advance. While these moves feel engineered, they rarely hold for long. Once selling pressure fades, price discovery resumes, and often at higher levels than before.
Well, I'm not going to sell any of my physical until I see that gold to silver ratio at least, at this point, probably at least 25 to 1. So at that point, I would probably sell 75% of my my physical gold and silver holdings, hang on to the last 25%, see how much further, maybe it can get down to 15 to 1. I would sell all leverage and even if we get below 30 to 1, I would probably sell at least 50% of my leveraged trades, probably 75% of my leveraged trades, and maybe just go completely unleveraged in my trading account. Now, the physical is a much bigger position for us. My recommendation, and pretty strict recommendation, is 80% physical. Physical that's your insurance. We can trade that other 20% in leverage. We always err on the side of caution. So like if we're trading options, we're always going to buy a ton of time just in case we get caught. Like if this were to turn out to be an intermediate correction that's going to take several more weeks, we need a lot of time on those options. That's exactly what we did. We bought a ton of time just in case we get caught. So that's our protection for our leverage, but also our leverage positions are just much smaller than our physical position. And I expect over the long haul, we're probably going to make a lot more money in our physical position, our quote unquote get rich slow position. The leverage is our get rich fast position, but sometimes the leverage is our very painful position if you get caught and have to hang on for a few weeks while we work through a correction. So those positions are much smaller than our physical position. That's how I'm going to judge that we're getting close to that top, is that ratio. And we may also get a Dow gold ratio that's maybe down to 3 or 4 to 1. That would be something else I would look at. So there's no real specific price that I'm absolutely going to take profits at that point. If silver's at $250, but the silver gold ratio is only at 40, well, I'm going to keep holding. If the Dow gold ratio is 15 to 1, I'm going to keep holding. So yeah, I'm not going to pick a set price where I'm going to buy. I'm going to be watching probably those two ratios would be. And then also another thing to watch for is just kind of pay attention to what's happening around you. If your neighbor is bragging about how much money he's making in gold and silver, or the people you work with that know nothing about gold and silver are bragging about, they're getting rich in gold and silver, that's a bell ringing that you're pretty close to the top. We saw that during the housing bubble. You saw it during the tech bubble. People doing irrational things, people that had no idea what they're doing. They just know that their neighbor's getting rich and they want to get rich. So that's something else to look for. Look at, pay attention to those two ratios, and then pay attention to what's happening in the public. If a lot of people that, have no idea what they're doing are starting to brag about getting rich in gold and silver, maybe time to dance close to the door before that last chair gets pulled away.
Major market tops aren't defined by price alone, but by relationships. The gold to silver ratio, the Dow to gold ratio, and public participation all provide critical signals. Historically, silver peaks when the gold-silver ratio compresses dramatically, often below 25-1. Public euphoria is another tell. When casual observers start bragging about gains, risk rises. Physical shortages at dealers also tend to emerge near peaks. These indicators matter far more than daily price swings and help distinguish temporary corrections from true cycle endings.
I do suspect we're going to see some shortages at the bullion dealers when we get close to the top, just because there'll be so much retail buying, and I've got some inside connections with some of the bullion dealers, and during this smash, their buying was 2 and 3 times higher than any other time in history. So a lot of people are seeing this for what it is. You know, if you want to buy physical, the banking cartel gave you an unbelievable gift. Use this to load up on your physical.
I want to ask you as well about the gold and silver mining stocks. We've been talking about how you have a different approach than many people. And one thing I've been hearing recently is after that silver price move, people are saying, well, now it's time to rotate over to the silver stocks because they haven't had that catch-up move. How do you approach the mining stocks?
Well, I think they did have that catch-up move. If you look at the last 2 years, the mining stocks have gone crazy to the upside. And silver was still still suppressed under $50, but the miners, GDX had broken out to new highs, and I haven't actually checked what the price of GDX was, but considerably above the old 2011 highs or 2010 highs. I don't remember when it was. So in my view, the miners, well, gold was the first to break the suppression. That resulted in a huge short squeeze. The miners were second to break the suppression. They had a very nice move. I certainly think the miners are going to participate, but I tend to think that silver is going to outperform. Now, there will certainly be some junior miners that are going to go up, 2,000, 10,000%, but what are the odds I'm going to be able to pick that or put all of my capital in that one or two juniors? Not very good. You can certainly, do a little bit of gold, a little bit of silver, a little bit of a little bit of mining stocks, but I'm probably going to focus mostly on silver. I think it's going to outperform, and if I want to use leverage, I think I want to use it in silver for this final. Once we finish this correction, for that final parabolic move, because I think silver's probably got a date with $500.
Long-term strategy favors patience and balance. Physical metals remain the core position, insurance against systemic risk. Leverage can enhance returns but must stay limited and well-timed. In late cycle environments, silver often outperforms both gold and mining stocks due to its smaller market size and monetary industrial dual role. Mining equities may participate, but timing them perfectly is difficult. The bigger opportunity lies in enduring volatility without capitulation. If history rhymes, the final phase may be explosive and far larger than most expect.